Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And in the midst of what's becoming one of the wilder times in financial history, we have President Trump launching new trade wars by the day. And seems like a lot of things are finally developing fast. So it's great to have David Brady join me today from globalprotraders.com, also a commentator for Sprott Money. Certainly one of the voices in the market that I've enjoyed following and listening to. So David, great to have you on here today. How are you doing, my friend?
Pretty good, Chris. Thanks for having me on. Appreciate it.
Yeah, well, I sure appreciate you being here because, like I said, things sure seem to be accelerating to the next stage where guys like you and I have been watching the money printing, wondering when the rest of the world notices. So how about to kick it off, I guess the topic of the day is the trade war, which a couple of weeks ago we weren't hearing much about. Now it seems like it's expanding. We have Mexico, India, Trump's out last night talking about when he's going to raise tariffs again on China. So what the heck is actually going on?
I'll throw Australia into the mix there too, which is quite shocking given that Australia is the mini US. But anyway, that aside, yeah, it seems that like David Rosenberg, Zero Hedge published an article citing his view on Trump's tactics, which is something that I talked about a while back myself. Trump made it very clear in his bashing of the Fed that he wanted them to reduce rates and revert to QE. Well, he said it explicitly about a month ago when he asked for a 1% cut in interest rates and QE to start immediately. Mm-hmm. And the Fed obviously ignored him. Powell made that clear after the fact in interviews and has done so before and after that comment. But what better way to force the Fed to cut interest rates, to give them an excuse, to provide them the excuse that they need other than low inflation, which is a whole other debate, than start a trade war with everybody.
Yep.
Because that has two primary effects. One is to reduce economic growth, and the second is to undermine the stock market. And those are, they won't say it, but those are two of, if not the primary mandates for the Federal Reserve.
Yeah, I mean, it was interesting to hear, he started out with saying, well, the Fed shouldn't be raising rates. And of course, this was the same guy who was talking about a gold standard auditing the Fed coming into office. And I've been thinking the same thing where, geez, if you really wanted to force someone into cutting the rates, that's one way to do it because to me, it's hard to really grasp otherwise. I mean, maybe he just really believes in nationalism and putting everything on an island, but it's gotten so extreme. It's almost hard to see that someone could really be doing this thinking it's in anyone's best economic interest. Am I missing something there, or it's just hard to otherwise rationalize?
No, you're absolutely correct. And I'll forgive some of your listeners by saying this, but at the end of the day, Trump is a politician.
Yep.
And he wants to get reelected next year. So this plays well with his base. Make America great again, impose all these tariffs, man of action, and this will bring jobs back to the US. And he cites very specific examples of that because they're few in number. And that brings out his base come the next election. The other thing with regard to why have trade wars with regard to the rest of the world on the same point is, because it hurts the economy and it hurts stock markets, but it forces the Fed, and we're already seeing signs of that to some degree, but we'll get into that in a moment, to potentially cut interest rates and revert to QE, which is what Trump wants. The elections are quite a little bit away, so he has time to undergo what I've been predicting as the third and final leg of this stock market crash, which I believe has already begun again. And in doing so, when the Fed cuts rates, the market will still fall. That's always the case when they start to cut rates. But when they revert to QE, he'll get a rebound in the stock market, and I believe it's going to go to higher highs by the time the elections come around. So he can cite the performance of the stock market, which he's just tied his administration to in terms of performance, ahead of the coming election. So he's playing to his base, number one, and also virtually guaranteeing that the Fed supports the stock market and the economy ahead of that election. Again, reinforcing his chances of being re-elected. Whether or not it succeeds remains open to question, but I think it will. And he's got another rabbit he could pull out of the hat. He's got all these trade wars going on with these various countries, either already in motion for quite some time, such as China, or pending, such as those with with Australia. He's already imposed tariffs on India. Well, come around January, February, what if he started agreeing trade deals similar to what was agreed with Canada and Mexico, although Mexico is another issue now, come January, February, on top of Fed stimulus in the market? What do you think the stock market would do? It would shoot higher. And that's all he wants. He gets reelected, and then we'll deal with the mess after the fact.
Yeah, I think that's well put, David, because I had been thinking about this whole thing over the last month and wondered if that's what he might be doing. A few folks I talked to said, no, he wouldn't risk, the stock market going down in front of his election. Although, like you point out, with the timing now, sure, we're in June now of 2019. So, yeah, sink the markets for a month or two, or, I mean, geez, you could even have the thing go down the rest of the year and then, start with QE, all of a sudden, trade wars is fine. So will be a fascinating year and a half, to say the least, although hopefully someone, whenever they start the debates and the campaigns and all that stuff, I don't know if they'll let me ask any questions, but the one that I would love to hear an answer on from someone, Trump or anyone in the White House, if we now have a trade war against China, India, Mexico, Australia, obviously Russia relationship doesn't seem too cuddly there.
Europe.
At the same time that, and I mean, this isn't easy to do for the U.S., but setting new deficit records. So who exactly is going to buy all of these bonds?
Oh, the same people who are buying them today, Americans. Americans are buying all the bonds. I mean, you have got Japan is still buying, obviously, they're a close ally of the US. But it's no secret that foreign demand for US Treasuries has dropped. And it's been replaced, and Luke Roman has done some great work in this. It's been replaced by domestic investors, like money market funds are forced to buy them. Commercial banks are being forced to buy, the primary dealers are being forced to buy them, and mom and pop are buying them as well. So they're filling the gap. The issue that they run into is at some point, given the increase in the deficits and the increase in the debt and the sheer amount, it's going to have to be, they're going to have to find a new buyer. Put a different way, the Fed is going to have to revert to QE, not just to prop up the stock market. And this goes to, again, Luke came up with this with another Twitter analyst, Louis Curran, a fellow Irishman, called it the Fed's trilemma, and basically pertains to this, that the Fed has three mandates, nothing to do with the official ones. It's to prop up the stock market, because the stock market is 155% of GDP, and if the stock market fall, federal tax receipts collapse and the government becomes insolvent. So it's they must keep the stock market going up. Secondly, is the bond market need to keep yields down. Given the amount of the deficits and the debt, you can't have yields going up to any great degree. The same thing's happening in Japan, because the interest costs on that debt would explode, rendering, again, the government insolvent. So the third mandate is the dollar, maintain the strength of the dollar. Well, you can't have your cake and eat it. You got to pick two out of three. So either you have a strong stock market, you have a strong bond market in terms of prices, lower yields, or a strong dollar. Pick two out of three. Well, it's obvious that stock market is critical to government finances, as is the bond market. So which one are they going to sacrifice? The dollar. The dollar is going to be sacrificed on the altar for to ensure that the other two increase. And by doing so, you're going to be able to inflate away the debt, and at the same time, the foreign demand for bonds may actually increase because the cost of hedging investments in U.S. Treasuries, if you're a foreign currency holder, is greater than the relative spread in yield gain to their own bonds. Put simply, they get a higher return on their own bonds than they do on U.S. bonds because of the basis spread that they have to incur by hedging the dollar component back to their own currency. So if you make the dollar weaker, that basis spread that makes it an exorbitant charge makes U.S. Treasuries relatively unattractive to their own debt goes away. So foreign demand for bonds comes back. So that's what I believe they're going to do. Right now, it's domestic investors are buying the bulk of treasuries. But again, it's becoming saturated, that demand. And there's the only alternative that they have is, try to generate foreign demand again. And I will add one last thing. One of the reasons for the corporate tax cuts back in, two of the reasons, one of the reasons was to generate repatriation of cash stored abroad, if you will, back to the US, and that money would go into treasuries. You're seeing Apple buy it. It was one of the biggest buyers of treasuries recently. The other was to prop up the stock market and facilitate buybacks. Well, that's been achieved, but are they going to do another corporate tax cut? I don't think so. So I expect that the dollar is going to run into trouble in the short term.
Yeah, there's somewhere in there that something is going to come up a little short because, with all the money in the stock market and the U.S. economy already pretty weak, how much more can Americans buy? And you would think foreign demand would be helpful, although when you're launching a trade war against everyone, China's creating has already created a petro-yuan, Russia's dumped their treasuries. If they're counting on foreign demand, good luck with that. And I think you nailed it, that the Federal Reserve I guess they're planning on the Fed picking up a lot of it. And speaking of the Fed, as you mentioned a little bit before, or we got it into a little bit, now all of a sudden we hear this last couple days, the Fed governors, we hear, maybe it is time to cut rates. So it seems like Trump may be getting his wish. What do you see happening out of the Fed? We do have the June meeting coming up. Where do you think everything stands with the Fed now?
Okay, how do I put this? That first of all, they didn't refer in Powell's speech recently. He did not refer specifically to a rate cut in the short term. He alluded to the possibility of new emergency measures in the next crisis, which would include negative interest rates. And I posted a tweet on my summary of his speech pointing out many of the falsehoods and obfuscations that he made during that speech, because he was talking about negative interest rates. At the same time, he was talking about the Fed being more transparent. Then why didn't you state the term negative interest rates in your speech? Meaning they're not transparent. But cut a long story short, he didn't mention that he was going to cut rates. He talked about emergency measures that they could potentially use in the next crisis. Well, we're not in a crisis. And I think there's a couple of analysts that came out and mentioned this fact, that everybody's jumping on the dovish bandwagon, but they haven't said they're going to cut. The reason they expect what they're going to cut, that the Fed's going to cut, is because it's been priced in by the market. And they may indeed cut on June 19th. But here's the scenarios I see playing out. One is they don't cut, and you're going to get a negative surprise for the stock market in a big way. Secondly, they do cut, and it's a sell the news event. In other words, you see the market rallying since that speech. Everybody believes that the Fed, which pertains to your question in the first place, everyone expects the Fed to cut rates on June 19, and they do, and the stock market falls. Because you see this: buy the rumor, sell the fact, and those are the two primary. I don't see a scenario where it the stock market goes up on that news, maybe that day, but not very soon after. Because if you look back at all of the Fed rate reduction cycles after they've been increasing rates in response to a crisis, the rate reductions that is, the stock market continues to fall. 2007 is a classic example. You had the same thing happen in 2000. And I expect the same thing to play out again now. I have said consistently, no QE, no bottom. Until I see a statement that they're reverting to QE again, I believe we're going down in a third and final leg to either a double bottom at 23.46 in the stock market or lower lows.
Yeah, and actually interesting you mentioned QE there because I guess I have some weird hobbies here. Every once in a while I go through these Fed minutes, and because I've been wondering what they really might be planning, and actually did go through the May Fed minutes, where one of the things they mentioned in there was maturity extension program. And again, to this degree, they come up with these names, and I just found it interesting. They even had it in parentheses MEP, as if it's now a new official term like QE. It sure sounded like QE. And they were talking again about what we might do if, a crisis accelerates. And certainly for a central bank that tells us that the economy is fine, they do talk and mention their crisis plans quite a lot. So any thoughts? Do you think QE is coming sooner than later?
I don't think the Fed is going to have an excuse to revert to QE until stocks drop a lot further.
Yeah.
And they've been doing a lot of talking ever since the January FOMC and when they did their famous verbal 180, as I call it. But they haven't done anything. They just went on to pause. They haven't cut anything. They certainly haven't reverted to QE. But yes, I expect that they're going to be forced to revert to QE. But in order for that to happen, you need to see stocks fall a heck of a lot further. And that's why it's either a double bottom or at 23.46 or a lower low in the stock market, in the S&P to 21,200, which has been my prediction since February of 2018. But those are my expectations, Chris. I'll leave it at that.
Well, it makes a lot of sense, David. I've been thinking the same thing as, you extrapolate all this and then try and figure out how to actually respond, where I've been wondering if, based on the way the Fed does things, like you said, that, they will need to let the market sink so that you can then sell the Fed as the solution. So certainly will be a fascinating couple of weeks waiting until we see what the Fed has cooked up next for the world. And as that develops,
sorry, Chris, can I interrupt you there? You brought up a very good point about the Fed taking blame or ascribing blame to somebody else. They never take accountability for their actions, and I've been saying this since the dawn of time. But this trade, and certainly since March 2018, when this trade war began, it provides a perfect smokescreen for the Fed to blame the trade war for the coming drop in the markets, which we've already had the wave A down in Q4. We had the wave B rally since December, and now we're going down again in wave C, the third and final leg of this crash. And I noted in the first few comments of Powell's speech, and you've seen it in numerous Fed, they went quiet on it recently, but you can go back and look at Fed speakers' speeches, and you'll see that they keep citing the trade war as a potential negative for the economy going forward. Otherwise, the economy is wonderful, which is complete doo-doo. But that's what they say, and they blame the trade war. Well, it's interesting that even Kaplan said that a rate cut is by no means a certainty. We have to see how the trade war affects the economy and what its implications are. So my point is, and the reason why I want to jump in there is, the Fed is making every attempt to point the finger at Trump and his trade war, when that's like blaming the last guy to the party for the mess that ensues. the Fed has been creating this everything bubble, arguably since 2009. Well, definitively since 2009, but arguably since 1987.
Right.
So to blame Trump coming in the door for the ensuing drop in the markets is nonsense. And if anything, all it is, as I said in my tweet, the trade war is the match to the Fed's gasoline. The Fed has created this environment. They've created this bubble. They've created all of the debt by making it possible through ZERP and QE, etc. So yes, the trade war may actually ignite this problem, make it blow up in everyone's faces. But to blame Trump for, and I'm apolitical. I think politicians are all the same. But to blame Trump for this problem is ridiculous. The Fed owns this.
Yeah, it is amazing the theatrics that go on where, I wonder if you wonder how much of this stuff these guys believe. I mean, they have everyone riled up. Oh, is Trump stepping on the Federal Reserve's independence? I don't know. I mean, does it really matter? They both in the end want the same thing, and Trump's trying to blame the economy on the Fed. The Fed, like you mentioned, it was interesting. The Fed was saying, well, we're looking into cutting rates, and if the economy weakens, we might do that. I mean, at the same time, well, of course it's going to weaken because they're starting a trade war against everyone. And I think it leaves people confused often who aren't maybe following this stuff every day and able to read through it, which again is why I really appreciate you coming on and helping to unravel some of these things today for folks. And perhaps along the lines of solutions or positive ways that people can respond. Obviously, I'm a big fan of gold and silver in particular, and would love to hear your thoughts. I know you dig into some of the technicals as well, but where do things stand in the metals? And since I have a fondness for silver, if you want to touch on silver in particular, any thoughts there?
Yes, I wrote an article for Sprott Money there last week saying silver has bottomed and gold and the miners won't be far behind. And everybody keeps telling me, oh, well, gold's leading the charge now and so are miners, silver's lagging. You were wrong. Well, look, I don't base whether I'm right or wrong on 1 or 2 days. The fact is that if you look at the gold-silver ratio, it's at 90, which is close to a record.
Stunning.
Yes. So, there's some people saying it could go even higher. Yeah, maybe that's the case. But look, I go with history. If the RSI in something is sitting at 95 or at 5, if it's at 95, yeah, could it go to 96? Sure. But it's more likely to revert to the mean, which is around 50 or lower. Same with if it's at 5. Could it go to 4? Sure. But the probability is much higher that it's going to go in the opposite direction. It's an elastic band effect, I call it. And the same goes for the GSR at 90. On top of that, gold's doing well right now. But if you look at the technicals for silver, it never had any false breakout to the upside. Its sentiment hasn't soared on this recent rally. Gold's up to 61 on the DSI. Silver is, I think, around, I don't have it to hand, it's around 30, 31. So it's like half the pace. So the risk we have right now is gold could go, I think gold's in for, we had a nice run. I believe we're in a wave 1 of a wave 3 higher. And that has much more room to run. We're going to get a pullback, and I posted levels on Twitter. It's anywhere between 1325 to 1300, and then we're going to break 1370 and go up to the 1400s, and we'll get into where we go from there in a second. Silver is much more beaten down, again going back to the GSR. It underperforms on the downside. It underperforms gold, meaning it falls more. It's a beta play on gold. Mm-hmm. But when gold goes up, it's going to outperform gold. It always has. If you look back to the 70s, gold went up 24x in 6 years. Silver went up 36x. And you can see the same kind of numbers for the rally from 2000 to 2011. The same thing is going to happen. So forget the few days, at the start of this rally. Silver is going to outperform here, and miners even more so, in my opinion. So, so that's going to be great. The gold community and all the bugs are going to be, deliriously happy, and they'll be calling for 2,000 and 10,000 and so forth. I'm all about baby steps. I have real problem with long-term forecasts. I'm a long-term bull, but I'm not a fan of long-term forecasts. Let's get to the 1400s, which I expect where we'll be this year. But let's see where we are when we get there, because there's some major resistances in the 1400s. The biggest one for me is 1485. 1485 represents 50% retracement of the entire decline from 1923, the peak in 2011, to 1045, the bottom in December 15. That's the 50% retracement. If we get to the 1500s, it's probably hi-ho silver time. But if we can't get through to 1485 in gold, there is a risk that we could drop to sub 1,000. And so what I'll be doing, you're asking to your question, and I'm not a gold bug. I only started buying it, and maybe I've become one, but I only started buying it in the second half of 2015 because I follow multiple tools, and all of them were pointing in the same direction, which was up. Nobody was bearish gold back then because nobody cared. Nobody was looking at it. The market was completely apathetic to gold, and to me. And then when I looked at all the indicators, everything set higher. Well, the problem is when we get to the 1400s, everybody and their dog is going to be extraordinarily bullish, and probably breaking out parties in the champagne. So there's a risk that could be the peak and we head lower. So in order for prepping, enjoy the ride, guys. But when it gets to 1400s, I'll be adding hedges, deep out of the money hedges, such that if in the next 2-3 years thereafter it does fall to sub to 1,000, you're going to clean up on options, put options in gold, silver, and the miners if it goes down there, and you buy, say, 20% out of the money, 30% out of the money, whatever the cheapest put option is, and just put it in a drawer, forget about it. And if it doesn't happen, it's because gold's gone to 2,000, 3,000, 4,000, 5,000. You won't care. You've made so much money. If it does happen, you're covered. If it does go below 1,000, that is.
Yeah, I think that's a great point, David, and appreciate you mentioning that, because certainly, I fit in the camp of, if people call me a gold or silver bug, I think they're both have great investment profiles and will eventually hit some of those big numbers that you just mentioned. Although I keep in mind that, part of the whole trading and investing game is that it's great to know what the fundamentals are, but also realizing the pricing is when other people recognize what you're seeing, and the path between here and there can be rocky. Certainly we saw both gold and silver in 2008. Gold, I think, went from about $1,000 to 700, silver from 21 to 9, while the Bear and Lehman were collapsing. So certainly I think it's good for folks to keep in mind that there's the long term, but the path there can often be irrational. So that's a good strategy to think about for folks, because, again, along the same lines, we could have the dollar crashing yet have a rally. People say, well, they're buying dollars in safe haven treasuries, even as those assets are collapsing. But I guess that's just how the world works sometimes, and perhaps trying our best to navigate that hopefully will be the fun part. Perhaps, yeah.
Let me add some meat to the bone here. One of the tools you use is Elliott wave theory and intermarket analysis. And intermarket analysis with respect to gold, I'm going to cite the dollar. With regard to Elliott wave theory, the big debate in that community is we had the big move up to 2011 high, and now we've had our pullback. The big debate is, was the low in December 2015, was that the low for wave 2, and now we're going up in wave 3 to 5,000, 10,000? Or has it not been completed yet, and we still have to go down to 900, 700, or 400. And not to get into too much details on this, but the point's being made that we could get up to the 1400s, and that's the top of this wave B rally in wave 2 down, and then we've still got C lower in wave 2 to go, and that takes you down to 900, 700, 200. But the other side is saying that we bottomed in December 2015, and if we take out those 1400s and we continue higher to 1500, 1600, and so forth, then the bottom was indeed in December 2015, and we're going higher. So that's the Elliott wave case. That's why that 1400 zone is so critical. So let's talk about the dollar. There's a massive debate going on with some, pretty major names of the community on both sides of the debate. And I'm not going to get into the bull-bear debate, but from my perspective, if the Fed is going to reverse course and, looking at pricing and the development of the dollar since 2017, that pricing performance, those charts reflect this, in my opinion, at least in the short term. If the Fed cuts rates and reverts to QE, that pulls a major rung of support from underneath the dollar. The relative growth and the relative yields are attractive relative to the rest of the world. But if you cut those rates and you revert to QE and force the yields down, that attractiveness goes away, and at the same time you're printing money. It also addresses one of the dollar bull theses, which is the dollar shortage in the world. Well, if the Fed's printing money to buy bonds and giving it to the banks, well, unless it stays on the Fed's balance sheet, which it may or may not do, that is addressing that dollar shortage issue at the same time. So you've taken two legs of the stool away from the dollar. So I think the dollar goes down. But this is what the dollar bulls don't seem to get. I'm focused on the near term. This just makes common sense. Now, the dollar bulls are saying that if the world goes to hell in a handbasket, all of these flows are going to come back into the US because it's the only safe haven in the world. And I think in the interim, that is certainly possible. That is certainly possible. Short term, dollar down, gold up. Interim, dollar goes shooting higher, gold goes down. That would satisfy the Elliott wave bears on gold. But long term, and this is where the bulls and the bears agree, that dollar is going down, because when that dollar goes up, it's going to destroy the world and the US with it. Because you look at August 2018 and what happened in August 2018. You had emerging market crisis in FX, and it was spreading globally. And I'm not just talking about Turkey and Argentina. I could run down the list: Poland, Hungary, right, South Africa, you name it. And it was spreading everywhere. And then that then spreads to the debt of those countries because they can't finance their dollar-denominated debt. Well, what happens then if they default on that debt? Well, the banks that are holding that debt get into trouble. Well, those banks deal with American banks. So there's a domino effect. And then, QED, the rest speaks for itself. You have a global crash. So the world cannot tolerate a stronger dollar. That would bring down the global economy and global markets. And at the same time, you've already got this de-dollarization process going on at the moment. And in that environment is what will lead to global collapse, a global monetary reset. And if you don't have gold or silver in your vault at home or in a vault with Brinks somewhere, you're going to be hurting. You're going to be in a world of hurt because they're going to devalue all the currencies around the world. They're going to wipe the slate clean with regard to the debt. And the two assets that are going to soar beyond belief are the hard assets like gold and silver. Even if they fall to $400, they're more likely to be $4,000 in 2025, 2030 than be at $400.
Yeah, it sure looks that way, especially, silver trading below what it cost a lot of these guys to get it out of the ground. I think gold is a little farther away from its cost of production, but not that far. And David, everything you're saying makes a lot of sense to me. Certainly in many ways unfortunate that, the governments and central banks seem to be playing a game of battleship with the monetary system and these trade wars. Yet I appreciate you coming on and helping to make some sense out of this. I know for some folks it's a confusing time trying to put all these pieces together, but I think you laid it out pretty well. And again, it's really been a pleasure following your research. You have some great ideas and really ahead of the curve on these things. So perhaps just in wrapping up, one more time, you can let folks know how they can find you.
Thanks, Chris. Yes, my website is globalprotraders.com, which covers. It's a site that I built so that's free and enables people to share their ideas and opinions with regard to the markets. We don't subscribe to any one particular tool. It's a holistic site in the sense that you can cite technicals, fundamentals, intermarket analysis, positioning, sentiment, Elliott waves, trends, DeMarks, whatever you want, because the whole idea is that someone brings something to the table. We emphasize fact and database, so it's not just shooting from the hip, which you get a lot on Twitter. And it's a robust community of professionals and amateurs sharing their views, all with a view to optimizing their trading and investing strategies and making money at the end of the day. So, and you can find me on Twitter at globalprotrader without the S. And my email's there on the site as well if you want to email me.
Well, David, I appreciate you joining me again. Folks, go check that out, globalprotraders.com and globalprotrader on Twitter. David, you're doing a great job out there. Pleasure to finally catch up with you, and we'll do this again soon as the action unfolds.
It was great talking to you, Chris. Thanks for having me on.
All right. Thank you, my friend.